Hello, Professor Zing. My name is Lexton Bunting, and I am presenting the final case submission for Next Era Energy. Here we have the overview for the firm. It is the provider of electricity-related services, primarily within the United States. Here we have four main subsidiaries. We have Florida Power and Light, Next Era Energy Partners, Next Era Energy Resources, and Next Era Energy Capital Holdings. The partners and capital holding subsidiaries, they're going to have to do a lot with the financials here. Capital Holdings is the ones releasing bonds, which we'll go over soon. Florida Power and Light, as you can see here, 82% of the sales per business comes from Florida Power and Light. So that is a huge subsidiary in terms of operating profit margin for NextEra Energy, with a 17.7% of sales coming from NextEra Energy Resources. That's going to be all of the nuclear power plants and the solar panel plants too. It is one of the top three firms in the American industry for energy, and the vision of the firm is to become the primary leader in renewable energy sources for the United States by 2045. So step one, the firm and market characteristics. So here we have the competitive advantage. Like every other firm, we are trying to maximize shareholder value. We are also trying to empower workforce through ethical considerations, which we'll cover later down the road, and the corporate social responsibility through their zero carbon blueprint plan, which is absolutely amazing. It's to cut all carbon emissions by 2045, which we'll go over too. Secondly, regulatory and operating characteristics. Their plan is to reduce natural gas dependency through that zero carbon blueprint plan, increase renewable projects and contracts, which we'll go over, and the key components to be competitive within the industry, that being renewable projects like we covered, selling off non-renewables and getting new contracts for renewable energy within the eastern seaboard of the United States, even with the government interest regulations happening right now, which we'll cover too. Industry trends, the future is going to decarbonize energy. That is wind power, solar panels, hydroelectric, all that stuff. And inflation rate is really hurting this industry just because that inflation rate hasn't fell yet for 2024. A lot of industries are expecting it, but it just hasn't happened yet. So step two, this is the revenue outlook. And here I've included five graphs here. It covers operating profit margin on the top left. Below that, that's return on assets. Below that is return on equity. And then we have earnings per share, and then we have gross profit margin. So the two main ones I want to show you are the earnings per share and gross profit margin, just encompassing all of them. The NextEra Energy is above the industry. The industry is the orange, while NextEra Energy is the blue. As you can see with all of these graphs, NextEra Energy is on top of the industry here. The returns on assets and equity remain stable even when NextEra Energy is selling off their non-renewable portfolios. We do see the EPS increasing due to new dividend promises to 2026. So as we can see here, from 2020 to 2023, we are raising the earnings per share from $1.48 all the way to $3.60 per year in 2023. But the gross profit margin is decreasing, like I said, due to the sale of non-renewable portfolios. So we see here in 2020, we were at 77.28. And then in 2023, we are decreasing with that trend line to 69.51 and decreasing further from 2023 to 2027 if the new renewable contracts don't produce profits within the next years. So step three, investments to support business strategies. So all forecasting that we did as a group assumes fixed inflation rate, competitive advantage, fixed market trends, and fixed consumer confidence. So NextEra Energy does have a positive forecast regarding asset management and operational efficiency. The average days in inventories is decreasing and the fixed asset turnover is increasing, which is great. You can see that below with the NextEra Energy efficiency ratios graph that I put together from 2019 to 2027. It also creates a healthier operational efficiency to raise the needed cash flow for future business strategies. Those future business strategies, like I said, are renewable contracts that they're getting through the eastern seaboard of the United States. And the average collection period is wavering, so it must stay below 55 to 60 days as to not encumber that operational efficiency to gain needed capital to just fund these capital expenditures. So step 4, future profitability and competitive performance. So increasing financial leverage to fuel liquidity, innovation, and a competitive advantage. So the operating profit margin and the net profit margin is increasing for the fiscal year of 2024 and 2025 compared to past financial cycles, as you can see from the balance sheet analysis and income statement evolution. It will level out within 2024, 2025, as you can see, but debt is increasing and the EBITDA or EBITDA is going also. Leverage is increasing too from 2024 and 2025 there, so keep an eye on that. The other thing is corporate social responsibility platform to decrease CO2 emissions to 0% by 2045. That is that competitive performance there. The firm NextEra Energy is currently forecasted to cut CO2 emissions by 70% by 2025, which is an unbelievable feat. Step 5, future in external financial needs. So as you can see in that pie graph there, it shows the debt and equity split of NextEra Energy. Here you have 47% in book equity, and then another 3% in equity credit for equity units or / hybrids that make up the adjusted equity of 50%. We do have 50% in debt too. The Florida Power and Light debt is 23%. The NextEra Energy Capital Holdings debt is at 23%, and the NextEra Energy Resources debt is at 4% there. So it does remain reliably healthy through cautious use of debt when compared to competitors. So as you can see at the bottom left, peer comparison to adjusted debt as a percentage of total capitalization. In that green bar, you can see that's 47%. The other peers in the category within the industry do have a higher debt equity for their firm. So there is a diverse spread of equity and debt to obtain needed capital for expansion. The 3 largest sources for 2022, as you can see from the bottom right in the historical funding graph, is debentures, tax equity, and non-recourse debt. So strategically managing cash flow, optimizing working capital, and utilizing proceeds from asset sales will assist the firm to minimize external financing requirements. Step 6, access to target sources of external finance. So we do see a 10% growth in dividends through 2026. So that current rate per share it's going from $1.78 to $2.48 with a dividend yield of 3.28% on their dividend. There is a continuing expansionist business model. It increases of both capital expenditures and operating cash flow by 10% from 2000 to 2022. So as you can see on the bottom, growth of operating cash flow and capital expenditures graphed here, we can see an increase of capital expenditures and an increase of that operating cash flow. The Inflation Reduction Act also allows increased tax equity returns for the company due to more government regulation around renewable energy. So that will really help when the company does move into renewable contracts, and also to gain more debt for just to gain more debt for their subsidiaries. NextEra Energy Partners is also releasing a Series Q Junior Subordinated Debenture that will mature until 2054 with a rate of 6.7% to 2029, and then decrease to the 5-year Treasury rate just for inflation to match inflation there, plus a 2.364% on top of that in 5-year Treasury rate until 2054. Step 7, so this is our 3 to 5 year plan here. Firm and subsidiaries are selling off many non-renewable projects as stated, such as the Texas pipeline, Next Era Energy Partners is selling that and natural gas assets in past and coming years. So the cash flow from operations is remaining constant, which is a good sign. In 2018, we had 6.6 billion, and now in 2022, we have 8.3 billion. So that is staying steady with a little bit of increasing cash flow from operations there. There is a decrease of assets with good steady cash flow and increased capital expenditures. So it is going to be interesting within the coming years to see if they can just have that as a good threshold, or yeah, just a good threshold from that cash flow from operations. Subsidiaries are focusing on opening long-term debt options, as we covered in the last slide, that Series Q subordinated debentures there. Rather than equity-based instruments, we do see NextEra Energy investing more into their dividends, just to invite new investors into the portfolio there. And there is promise to, like I said, increase quarterly dividend values until 2026. So that allows the earnings per share to increase. And like I said, the dividend yield is increasing to 3.28% there. So step 8, stress test under scenarios of adversity. So according to the NextEra Energy's Form 10K, two major risks will hinder the growth of the firm. The first one is government interest rate and energy regulations, and the second one is operational risk through sale of subsidiary assets. So I would like to point your attention, to this graph on the right-hand side. That's going to be the U.S. primary energy consumption by major sources from 1950 to 2022. I would like to point out that the green line is the renewables and the orange line is nuclear, which the firm does say is renewable. And as that year is increasing, the need for those renewables and nuclear energy is increasing too. So this is data given by the U.S. Energy Information Administration that really helps kind of put together an objective quantitative look on things. So yes, the U.S. is becoming increasingly dependent on renewable energy. High interest rates in the past 2 fiscal years, renewable projects are having higher yields. So many contracts are being renegotiated, which is therefore extending project timelines, specifically wind-powered projects off the coast of Florida and Texas. So the second risk here is the operational risk through sale of subsidiary assets. So NextEra Energy Partners and NextEra Energy Capital Holdings are selling assets to increase their retained earnings account just to get that financial quote-unquote slack within that balance sheet. It increases leverage and risk as current assets of the firm decrease while long-term debt increases. And if project timelines are expanding due to higher interest rates, this could slow the firm's cash conversion cycle to a crawl. Step number 9, this is the current financing plan. So NextEra Energy Partners just released $10 million in Series Q junior subordinated bonds, like I said in the past, and told analysts the firm would start limiting equity. That is the CEO that said that there. These bonds were released as NextEra Energy is fighting against the increasing velocity of the S&P 500 upwards trend. So as we can see from this graph, the gray line there is the S&P 500, while the blue line is the NextEra Energy stock price there. So as we can see, NextEra Energy is fighting against the S&P 500 there. But that is just because they are selling off portfolios and they're getting new contracts as we are talking. So from that, if the NVPs and the IRRs are steady in those new contracts there, that could raise the stock price there. So NextEra Energy is also promising quarterly dividend growth and increased operational cash flow, even after continuing sale of non-renewable assets. So continuing on the current financial plan, as we can see here, the share of renewables set to expand in the U.S. energy mix. This comes from the United States Energy Information Administration. We can see that renewable energy or renewable sources are going to take off in terms of just the dependency with the United States consumer base there, especially around 2030 to 2034. That's going to really take off there with coal and petroleum and natural gas and nuclear also kind of curtailing there from 2030 to 2034. So the firm has secured multiple renewable energy projects across the East Coast, beating out their competitors while also paying a premium due to high interest rates. So we'll see what happens there if the firm is leaning too much into a new up and coming market there. But if all goes well, we can expect to see great returns from 2030 to 2034 if all goes well in these contracts. And like I said, the new project showing promising net present values and increased estimate of renewable energy dependency will just help the firm move forward. So in conclusion, NextEra Energy is at a catalyst point. The selling of non-renewable assets for renewable contracts at high interest rates will really have an ebb and flow on the operational cash flow and the balance sheet for this firm. The pressure of losing operational cash flow and decreasing gross profit margin doesn't really look good in terms of inviting new investors there. But if, like I said, these renewable contracts were to take off, that'd be a great turn for the firm. And then the new dividends to invite new investors, increasing long-term debt instruments to fund expenditures. So they will have the money to get these contracts, as we can see from them claiming contracts within the eastern seaboard of the United States. Even with the high interest rates there, they are trying to just get in the door there and make sure that they have a good piece of the pie, quote unquote, just to move into those renewable contracts. And government regulations in that zero carbon blueprint plan to just help guide leadership actions and have that corporate social responsibility there to move forward. So with the United States poised to increase their dependency on renewable energy sources and the federal interest rates begging just to fall soon, NextEra Energy is primed to either become the North American renewable energy industry leader or the firm who leaned too far into an up-and-coming market. So ethical considerations for NextEra Energy, there's two major ethical issues here. Firstly is the new construction of solar panels to fulfill solar energy contracts within their eastern United States. One of the biggest things for solar panels is polysilicon, which is the needed ingredient for new solar panels. There's actually labor lawsuits for Chinese mining plants that actually do produce polysilicon. So it is a big ethical issue just because if it's in that supply chain, there is some labor lawsuits there. So no statement has been released by NextEra Energy, which could weaken the future investor relations as we go more into these renewable contracts. Secondly is the maintenance of 3 nuclear energy plants within the Midwestern United States. Nuclear disasters such as Chernobyl and Fukushima towering over the nuclear industry. It has to be a precedent that the firm will do everything in its power to just work closely with the United States governments just to fulfill regulations, give quarterly trainings to employees, and they have created meltdown contingency plans, which will help with the United States if there ever was a meltdown was to ever occur. And finally, these are all of our resources here. Thank you so much for your time, Professor Zing, and look forward to your opinions on the presentation. God bless.